All right, let's just dive right into this explainer. Today, we're going to completely flip the script on that traditional idea of trading your time for money. You know the drill. Most people spend their entire lives waking up early, working hard, and just repeating that exact same cycle for decades. But right now, we are going to introduce the concept of making your money work for you, literally while you sleep. We're going to break down some incredible insights on how the stock market actually functions, how you can look under the hood of real businesses, and ultimately, how to build long-term wealth without needing to be some kind of Wall Street financial genius.
To keep things super simple, we've got a clear roadmap for today. 1. Why you must invest. 2. Stock market basics. 3. Reading the balance sheet. 4. Building your portfolio. And 5. The psychology of investing. Okay, let's get into it.
Section 1. Why you must invest, confronting the silent wealth killer. So I want you to ask yourself a kind of wild question. Is your savings account actually making you poor? I know, it sounds totally backward, right? Your money is safe and sound in the vault. But here's the catch. With inflation causing prices to rise every single year, I'm talking food, rent, cars, the whole shebang, the actual buying power of the cash just sitting in your bank is quietly shrinking. It's literally a silent wealth killer. When we actually stack up the tiny return of a typical bank account, which is maybe 1 to 2% a year if you're lucky, against the historical 10% average annual return of the stock market, the difference is absolutely staggering. Now, to be clear, the market doesn't guarantee 10% every single year, and it for sure has its down years. But over the course of decades, the massive difference that compounding makes at 10% can completely change your financial future. Moving right along to Section 2, Stock Market Basics Explained. Owning a piece of the pie. Here is the absolutely crucial point to remember. When you buy a stock, you aren't just tossing money at some random chart on a screen or making a blind bet in a casino. No, you are buying a tiny piece of a real functioning business. This is what we call equity capital. So if that company grows, say they open a bunch of new stores or create some revolutionary new phone, your piece becomes more valuable too. Plus, a lot of companies will actually pay you a cash bonus just for holding their stack, which is called a dividend. Pretty cool, right? And the whole market ecosystem is just a brilliant way of connecting everyday investors to these companies. Because obviously, you don't just walk right up to a business headquarters and hand them a stack of cash. Instead, you use a licensed stockbroker. That broker connects you to a centralized stock exchange, which essentially just matches buyers and sellers based on the basic, everyday economic principles of supply and demand. If demand for a company's stock is high, the price goes up. It really is that straightforward. All right, Section 3, Reading the Balance Sheet, the ultimate lie detector test. If we want to avoid dangerous investments, we have to look under the hood. And the foundational rule of accounting is incredibly simple, built on just 3 pillars. First, assets. That's what the company owns, like cash, buildings, and inventory. Second, liabilities, what the company owes, like bank loans or unpaid supplier bills. And third, shareholders' equity. Think of it like this. If a company sold off all its assets today and paid off all its liabilities, the cash left over is the shareholders' equity. The fundamental equation is just assets equal liabilities plus shareholders' equity. Now, to get a much clearer picture of a business's health, investors will split these assets and liabilities into 2 distinct time horizons. You've got current items and non-current items. Current just means short term, so cash coming in or bills due within the next 12 months. Non-current means long term, like a massive factory they'll use for decades, or maybe a 10-year corporate bond they don't have to worry about paying off anytime soon. Let's put this into perspective with a real-world example. Take the number 1.83. This was actually the current ratio for Alphabet, Google's parent company, at a specific point in time. You calculate this just by dividing total current assets by total current liabilities. So a ratio of 1.83 means that for every single dollar of short-term bills coming due this year, Alphabet has $1.83 in quick cash assets to easily cover it. That right there is the hallmark of an incredibly liquid, financially bulletproof company. Let's shift gears to Section 4, Building Your Portfolio. Index funds, and modern portfolio theory. So in the investing world, you're constantly going to hear about 2 main schools of thought, growth and value. Growth companies prioritize rapid expansion, and they're constantly reinvesting their cash to get bigger. This makes them inherently riskier, but with a much higher upside. Value companies, on the other hand, are your steady workhorses. They might be trading at bargain prices, they have super proven business models, and they regularly pay out those dividends we talked about. The most prudent investors, well, they don't choose between Batman and Superman here. They usually want a strategic blend of both. And that leads us directly into modern portfolio theory, or MPT. MPT suggests that combining different risky assets can actually lower your overall portfolio risk. The secret sauce here is correlation. You basically want assets that respond differently to the exact same economic events. So if stocks drop, maybe your government bonds hold steady or even rise. By diversifying like this, you effectively mitigate unsystematic risk. That's just a fancy term for the danger of one single company or industry completely failing and dragging all your hard-earned wealth down with it. Which brings us to a total game changer of a tool: index funds. If picking individual stocks feels way too risky or just too time-consuming, index funds are going to be your best friend. They let you buy tiny pieces of hundreds or even thousands of companies all at once. The way I like to think about it is, don't bet on one athlete to win the race. Own the entire stadium. If one player trips and falls, the stadium still thrives. It's simple, it's significantly lower stress, and historically, it's incredibly effective. When you actually map out global market performance across different geographies, it completely exposes the total unpredictability of the global markets year over year. I mean, the absolute top performer in one country one year might be sitting at the very bottom the next. It perfectly illustrates exactly why spreading your investments across different regions and asset classes isn't just a good idea, it's absolutely vital. And finally, Section 5, the psychology of investing, mastering the mental game. Because let's face it, the math is the easy part. Managing your emotions is incredibly hard. Honestly, our brains are hardwired to be terrible at investing. You have to be aware of these emotional traps. There's regret aversion, which is basically just financial FOMO, leading to dangerous impulse buys. Then there's familiarity bias, where you only invest in your home country or just the companies you recognize, which totally destroys your diversification. But the absolute most dangerous is disposition bias. Studies show humans actually feel the pain of a financial loss 2.5 times stronger than the joy of an equivalent gain. That intense emotional pain is exactly what drives investors to panic sell at the absolute bottom of a market crash. So, what's the best defense against your own brain? It's an automated strategy called dollar cost averaging. You set up your investing so that a fixed amount, let's say $50 a month, is invested like clockwork, totally ignoring whatever the scary news headlines are screaming that day. When prices are high, your $50 buys fewer shares. When the market crashes and everything is on sale, your $50 automatically buys more shares, and you never have to emotionally guess if it's the right time. Automation completely removes the emotion. I really want to leave you with this final, powerful thought from Warren Buffett. He said, "The stock market transfers money from the impatient to the patient." You really don't need to be a financial genius to build incredible wealth. You don't need to perfectly predict the future or time the market. You just need consistency, a diversified plan, patience, and time. So ask yourself, starting right now today, are you going to be the impatient one endlessly trading your time for money, or the patient one finally letting your money work for you?